Hi, my name is Greg Milano, and I'm founder and CEO of Fortuna Advisors. I'm going to talk now about motivating people to act like long-term committed owners. What is an ownership culture? An ownership culture is where people think and act as they would if they owned the business. If you can imagine that you and your colleagues owned the company that you worked for, and you think about the kinds of things you would do in terms of driving performance, in terms of how you'd care for the communities and the employees and the consumers, and how you would think about investments in the future. Well, those ways of thinking are the ways that people think within an ownership culture. So I'm going to talk a little bit more about the features of an ownership culture and some of the ways to get there, and then give a few case study examples. First, I'm going to start with 5 key traits of an ownership culture, and I'm going to contrast them with what we see as typical behaviors inside of companies. First, we have spend your budget or lose it. Whether it's a capital budget or an expense budget, people realize that if they don't spend what they were given, they may not be given as much next year. So there's an incentive to spend money, often in ways you would not spend your own money. But in a true, authentic ownership culture, people spend money like it's their own, which means they're careful with not spending money on things they think are wasteful, but it also means they're more eager to spend money on things that are really good for the business, even if they're not in the budget. They'll go back and ask for permission to spend if they need to in order to do what's right for the business. The second typical behavior is what we call peanut buttering, which is the sort of smearing of resources, capital, innovation money, marketing money around the organization, across businesses, across brands, across regions in ways that gives everybody a little bit and kind of hedges things. In an ownership culture, we don't see that at all. What we see is extreme prioritization. People really figure out where they create the most value, and they really load up the resources in those areas where they do the most good. Much more like the way people pick stocks and building a stock portfolio. They don't just buy a little of everything. They tend to put more money into the ones they think are going to create more value. In a typical company, often these days, people are so risk averse, they avoid even good risks where the return is worth the risk. In an ownership culture, people are much more willing to experiment and even fail and learn from that failure as part of the path to being more innovative and successful as an organization. In typical companies, there's often a measure of indecisiveness where there are meetings after meetings after meetings. What we often use to describe this is analysis paralysis. Every meeting ends with, oh, well, let's study this one more thing and then we'll get back together. And that keeps happening over and over again. In an ownership culture, there's much more doing and a lot less talking. People have far fewer meetings to come to a decision. Should we do this? Should we not do it? And they move on. And that's the way owners behave as well. And then lastly, there's such an emphasis these days inside both public and private companies on annual performance and even quarterly variances to plan. And there's 2 problems with that. One is it's too short term, and the other is when we talk about variances to plan, we're like paying people to plan for mediocrity. They want to plan low so it's easy to beat. In an ownership culture, there's a really heavy emphasis on both the long and the short term. Owners that I've met tend to drive current performance as strong as anybody, but they would never get there by cutting R&D or cutting advertising or reducing their investments in the future. So in an ownership culture, it's always about both the long and the short term. There are 3 major problems in traditional incentive plans that stand in the way of accomplishing the kinds of behaviors we talked about on the prior page. The first is that most companies use far too many performance measures, and those measures are very incomplete. They each only capture one aspect of performance, and so it really obscures how value is created. 3 measures look better, 2 look worse, one's kind of unaffected. Is it a good decision? Is it a bad decision? That's what leads to the prolonged decision making and the analysis paralysis. The second one is this measuring of performance against plan leads people, when they're developing their plan, to understate the revenue and income expectations that they have in order to have easier targets. In addition, that whole process of negotiating those plans and targets is not only counterproductive, but it creates secrecy where people are unwilling to tell their boss what they really think is going to happen in the business because they don't want it to be folded into their targets. They want to get paid for it. And so this act of measuring performance variances against budgets and plans is a very big behavior problem that we need to get away from. And then lastly, there's the real or perceived downside for something going wrong often is much bigger than the upside for success. if one of your worst parts of your business does badly, you might lose your job. But if one of your best parts of your business does a little bit better or a little bit worse, it probably doesn't mean much in terms of your career. So people tend to really focus on avoiding downside rather than maximizing upside. This extreme risk aversion stifles innovative thinking, and it really leaves a lot of potential upside on the table. We've shown in research that the average upside is worth so much more than the average downside, that there really should be more of a leaning that way. But inside of most companies, there's much more of a fear of failure than there is an excitement for success. So we have a measure we call residual cash earnings that dramatically improves the growth versus return trade-off. And it's a single measure that we can focus on because it captures pretty much everything else that other measures do. We start with what we call gross cash earnings, which for many companies is just EBITDA minus tax. We do treat R&D as an investment, and we can treat marketing as an investment as well. So we get a little bit better picture of the sort of profit versus return on investment profile. But for the core kind of just basic company that doesn't have a lot of R&D expenditure, again, this is just kind of EBITDA minus tax. Now we subtract from that a capital charge based on the gross investments in the business, the gross operating assets multiplied by something we call the required return, which is similar to what some people call a cost of capital. Now, what's really important here and different from most financial measures is it's gross operating assets, not net operating assets, not depreciated operating assets, because we're not charging depreciation against gross cash earnings. We don't depreciate the assets in the capital charge. And so when you buy an asset, there's a sort of steady charge for that asset over the life of the asset. What's left over when we subtract the capital charge from gross cash earnings is residual cash earnings, RCE. Very often we name it after the company that we're working with, but the generic form of it is RCE. And again, R&D can be treated as an investment in this paradigm. Now, there are three motivations that come out of RCE. The first is invest in growth. Invest in as much growth as you can. Growth is an unbelievably important driver of total shareholder return, as long as each of those investments generates an incremental return that exceeds the required return. In order to get more RCE, the gross cash earnings has to be bigger than the capital charge. Now, the beauty of this is we're going to measure RCE against last year. So if a manager makes an investment that doesn't generate enough gross cash earnings to cover the capital charge, RCE will go down and they will make less money. In such a way, we're actually encouraging people to think about those capital investments, whether they're R&D or fixed assets, as if it was their own money. Because if they don't cover the required return, part of the money they destroy is going to be their own. And so residual cash earnings measured against last year encourages people to really think through, do I really believe my forecast? Do I believe this growth investment is going to earn an incremental return above the required return? Second one is operate by improving price, cost efficiency, capital productivity. And these incentives to operate are basically the same as what you get in most any other incentive plan that that you see. Everybody wants to be more efficient and productive and so forth. But it's good that this encourages that just as much as it encourages growth. And then lastly, harvest activities that maybe are worth more to somebody else. You can sell a non-performing asset to somebody, take the capital and put it into something more productive, and that helps to improve RCE as well. Both the act of getting rid of the unproductive asset and putting the capital into a new productive asset, can help a lot. So RCE is a very comprehensive measure. You don't need any other financial measures when you're using RCE. One way we try to prove the sort of value of RCE is by showing how well it tracks share prices. And one of the best examples is Amazon, a company that often people struggle to really figure out what the company is worth. From an accounting perspective, many of these years shown on this graph did not have any accounting profits. But when we calculate RCE, treating R&D, all of the what is known as R&D inside of Amazon, as an investment with a 5-year life instead of as an expense with a 1-year life, and then we value the company as if each year the RCE that's produced were expected to be repeated going forward. So we're just capitalizing the RCE on a present value basis, adding it to the RCE operating asset base. What we get is an implied share price that over the last 10 years has actually tracked the actual share price phenomenally well. So if we have a measure that can track Amazon share price this well, using that measure to make decisions inside the company can encourage very good decision making, and it causes people to think much more balanced about the trade-off between investing in bricks and mortar and investing in intangibles like R&D and advertising, which get expensed for traditional accounting purposes. When we think about incentives, there's another feature of the way we measure the improvement in RCE that is important to understand, and the behavior behind it is important to understand. We often ask people, is it better to plan for 2% growth and get only 3%, or plan for 10% growth and get 8%? In a plan-based, variance to plan world, you'd be much better off planning for 2% and getting 3%. But if you own the business, you'd rather plan for 10% and get 8%. So let me just walk through this illustration and it'll make it very clear. So with traditional incentives, if in year zero we had a certain amount of performance, and in year one, because of good things that are happening in the business, we set a plan for improvements in performance, and then the actual in year one improves, but not as much as we planned, these managers created value, they improved the measure, but they get underpaid because they didn't improve enough to hit their expectations. So what do? When they look at year two, they say, "Ooh, we better be careful. We better plan low, otherwise we're going to struggle, to get paid." And here in year two, you see they planned low. They were very conservative. They sandbagged, I think is the technical term. They outperformed their plan, but they still declined in performance. So the value of the company goes down in year two, but that year they get paid superior bonuses. With an RCE-based incentive plan, the target is always last year. If you can improve EBITDA enough on an after-tax basis to more than cover the required return on all your incremental investments, then RCE rises and you get paid more. And when you can't cover that capital charge, then you get paid less. So the target for year one is simply year zero. There's no negotiation. The amount of EBITDA improvement you need is driven by how much you invest. If you invest more, EBITDA has to go up more. And if you don't invest very much, well, then the EBITDA improvement target is fairly light. When we look now at year one, same exact numbers as above, people get paid for creating value. That now becomes the basis for the target in year two. And again, we underperform, so we now get paid less in year two. So when value is created in year one, we get paid more than target bonuses. When value gets destroyed in year two, we get paid less than target bonuses. But we have a real incentive to bounce back in year three. If you look at the year two and year three timeframe, possibly they made an investment in year two that had incurred some expenses and some capital charges that would take a little bit of time to pay off. And then by year three, you can see now the actual is above where it was in year one. They were already just 1 year after they made the investment getting a return for their investors. And at that time, they also get paid back the money that they lost in year two, plus a little bit, because they're achieving a higher level than year one. So it encourages people to think through multi-year investments better. It encourages people to stop worrying about negotiating their plan. It gives them more freedom to plan aggressively for aspirational goals. The behaviors encouraged by being able to measure against last year with a complete measure like RCE are much more owner-like in their nature. Now I'm going to talk about 3 case studies: Varian Medical Systems, Elanco, and CSX. And the information here is all from the public domain, drawing on published proxy statements and other documents. First, we'll start with Varian. Varian is the world's leading producer of radiation therapy equipment for the treatment of cancer. They merged with Siemens Healthineers in 2021. Headquarters is in Palo Alto, California. When we started working with them back in 2017, they had 6,600 employees, and in 2019, just a couple of years later, they had 10,000 employees. Revenue, after being flat for a while, was $2.6 billion in fiscal year 17, and it grew to $3.2 billion in fiscal year 19. And at the time of the merger with Siemens Healthineers, the market cap was a little over $16 billion. Revenue growth in TSR had stagnated through 2017 as new product innovation slowed, and Fortuna partnered with Varian in mid-2017 to transform decision-making and create an ownership culture focused on value creation. This is directly from their proxy statement. This table on the left talks about their guiding principles and how they translate into the 2019 incentive plan design. If you also received the PDF version of this presentation, there are links at the bottom of each page to the proxies that are referred to on the slide. The comments on the right are directly out of the proxy. Alignment of executive incentives with our growth and value creation strategy. In fiscal year 2018, we revised our executive incentive plans to further align them with our growth and value creation strategy, including moving to an economic profit measure under our annual incentive plan, and we continue to leverage these design principles in fiscal year 2019. Note that in the proxy, Varian refers to economic profit, but internally and in later investor communications, it's known as Varian Value Added, or VVA. Directly from the proxy, you can see that the only financial measure was this economic profit measure, again, VVA, 80% weight, and then 20% was based on individual goals. They talked about their treatment of R&D in the proxy. R&D is very important in their business to develop advanced machinery in order to help combat cancer. What they said about their incentive plan is it incentivizes both growth and return on the capital invested in the business by driving innovation over relatively long product cycles through ongoing investments in R&D. They capitalize the costs and don't treat them as an expense in the current year for VVA purposes. And the capitalized R&D expenses are charged as a cost of capital in determining economic profit. In the Varian case, they capitalized R&D for an 8-year period. So after you spend the money, you don't get whacked with a big expense this year, but you get charged a capital charge on that investment for it in the next 8 years. And so you have to eventually earn a return above the cost of capital on that R&D investment, or else it's going to drag down your bonus. It gets people thinking about R&D the same way they should think about traditional capital expenditures in bricks and mortar. They talked very clearly about why they use VVA, ownership culture, how it affects decision-making, the balance of growth and profitability, and they also talked about how it tracks TSR, total shareholder return, which of course is very important in encouraging owner-like decision-making. They showed how the calculation works and described the R&D expense add back. I won't go through the detail on this, but it's pretty clear how they calculate the measure. They talked about target setting. They were very transparent about what the historical performance had been, how they set the targets, some adjustments the committee made in order to normalize for things that may or may not have affected the performance the year before. And then they showed some details on the calculation, including some discussion of, what affected different parts of this calculation. You can see in the second year of using VVA, it improved again over the prior year, which itself was a very significant improvement over the base year. Their long-term incentive plan, which we also helped them with, geared their performance share units and their performance share options around a performance test based on growth and the change in EBIT margin. We tested a lot of things empirically using business model peers to construct this diagram. And what happens here is if you grow more, or if you can improve margin more, you're going to invest in more shares and vice versa. And then we overlaid on that a relative TSR modifier, which only had a small impact, but an important impact. In any year when their TSR ranked in the any 3-year period where the TSR ranked below the 25th percentile, they could get no more than 100% payout. They couldn't get to 200 or 150. They can only get to 100% payout if their TSR was in the bottom quartile. And if their TSR was in the top quartile, for symmetry, we set it such that they couldn't get less than 100% payout. So, the management was protected when the TSR was really good, and the board and investors were protected when the TSR was very bad. And other than that, relative TSR had no impact, on the payouts. In their investor communications, and this is from their Analyst and Investor Day, November 15th, 2019, they again talked about ownership culture, how it encourages management to think and make decisions like owners. They talked about decision-making, how it aligns planning and decision-making with continuous pursuit of value creation. Again, the balance of growth and profitability, and again, the strong correlation with total shareholder return. And notice, by the way, in the footer of the slide, they refer to VVA. So although they talk about economic profit in the proxy and in the title of this slide, they do mention VVA, or Varian Value Added, down below. The voiceover for this slide came from Gary Bishoping, who had been the CFO from 2017 to 2019. And I won't go through all of these comments, but he says, so as you may have all read, we've adopted a concept called economic profit. We call it Varian Value Added, or VVA. The Varian Value Added of the company for the last 2 years has expanded. First and foremost, it drives extreme alignment with shareholders. And so that was really important. Then he went on to talk about ownership culture and thinking multi-year. And lastly, the nice part about VVA is that it incorporates and distills it all down into one metric that's dollar-based. And that singularity helps you in decision-making, again, avoiding analysis paralysis. There were some additional statements about the balance of growth and profitability, the correlation with share price, and very importantly, they talked about how they walked away from the Certex transaction. They were in contract to buy a company called Certex, and a competing bidder came along and upped the bid by 25%. When they ran the VVA math, they realized there was no way they were going to create value for shareholders if they paid that much, and so they walked away. They actually got paid a nice breakup fee as a result. And the graph on the bottom left shows that from the period before implementing VVA to the period after, and then to the acquisition price that came along, and they pretty much doubled the value of the company. When we look at the capital allocation before and after, if we focus on the pie charts in the middle of this graph, the upper pie chart shows the period before VVA was implemented. Notice that almost 2/3 of capital allocation was going to stock buybacks and a fairly big chunk to R&D as well. But when you look at what happened after they implemented VVA, they still did some buybacks, but meaningfully less. And a lot more money went into R&D, and a lot more money went into cash acquisitions. They made over 10 tuck-in acquisitions over the next 2 years, which helped them build software and services around their core equipment, and that helped them, to produce much better economics. If you look at the right-hand side, you'll see that growth increased more than fourfold from the period before to the period after VVA was implemented, and again, the employment increased significantly. The last part on this chart is the bottom bullet on the left. In under 3 years, the treatment of cancer patients by Varian's equipment increased from 2.8 million to over 4 million. So this was really a win-win for all stakeholders, including the patients being treated by their equipment. Next, we'll talk about Elanco, which is Elanco Animal Health. They innovate, develop, manufacture, and market products for pets and farm animals. They're based in Greenfield, Indiana. They have about 9,000 employees. Their 2021 revenue is a little shy of $5 billion, and their market cap is a little over $12.5 billion. They were spun out of Eli Lilly in March of 2019. In August 2020, they paid $7.3 billion for Bayer Animal Health. And so in the middle of standing up a public company and executing a large merger integration, there were a lot of challenges going on. And that's when they decided to embrace what they call Elanco Cash Earnings, which is the customized version of our Residual Cash Earnings. In their communications at the JP Morgan Healthcare Conference in January of 2022, they mentioned that they introduced a company-wide EVA-like compensation metric to further align employees and shareholder interests. In their letter to the CEO and president in their proxy in March of 2022, Jeff Simmons said that, to strengthen this culture of ownership for 2022, we have adjusted our Elanco corporate bonus to a more EVA-like compensation metric. As you can see down below, it says the EVA-like compensation metric is Elanco Cash Earnings, a customized version of RCE. If you look further in the proxy, you'll see that they talk about changes to the executive compensation program. And you can see it there in the top line. It talks about the new financial metric, Elanco Cash Earnings, how it replaces the 2021 metrics of revenue, adjusted EBITDA, and innovation performance in their incentive plan. And it's a cash-based economic profit, based on RCE. And they talk about prudent investments in R&D, and it's really it's an excellent, well-written statement in their proxy introducing the new framework. They go on further to talk about how they've also approved for their performance awards, they're part of their long-term incentive plan, a target adjusted EBITDAR test, where adjusted EBITDAR is the measure being used, and the target adjusted EBITDAR at the end of the cycle is based on the adjusted EBITDAR at the beginning of the cycle plus a pre-tax required return on the incremental gross operating assets invested in the business. So very consistent with the ECE measure. They created a long-term incentive that again encouraged them to only invest in new gross investments, new gross operating assets where they felt the return would be high enough to more than cover the pre-tax return. So this was a very consistent set of behaviors being encouraged by the annual plan, and we think this was an excellent move by Elanco. Next, we'll talk about CSX. CSX is the rail-based freight transportation company based in Jacksonville, Florida. Almost 21,000 employees. 2021 revenue was $12.5 billion. Market cap was just shy of $82 billion. Their 5-year TSR through 2021 was 236%, which was 84th percentile among the S&P 500, a very outstanding ranking. And with respect to the long-term incentive plans, in 2021, the committee began to shift its focus from efficiency measures, which have driven tremendous improvements in margin over recent years, to growth-oriented measures going forward. And this change that we made to their incentive plan to use CSX cash earnings was along those lines. They dramatically expanded margins in recent years, and they grew earnings per share pretty strongly. And when you look at this chart, you can see revenue up 13% over the last 5 years. That's cumulative over the last 5 years. Operating income margin up 38%, EBITDA up 43%, operating income dollars up 56%, net income up 121%, and EPS up 179%. So just tremendous leverage in the operating model, tremendous leverage in the financial management of the business to get to a just outstanding EPS growth and total shareholder return over the last 5 years. This was all delivered by embracing precision scheduled railroading, where freight trains operate on fixed schedules. It allows for a lot more efficiency and asset productivity, just substantial improvement in margin. Lately, though, management and the board have begun seeking to increase organic revenue growth without relaxing the discipline on cost efficiency and capital productivity. That was very important to them. They didn't want things to run amok with organic revenue growth. They wanted to take a disciplined approach, very consistent with their existing management mindset. And CSX cash earnings is being implemented to motivate profitable value-creating growth. In the proxy, they talk about for the 2022 to 2024 LTIP, the committee approved the use of CSX cash earnings, or CCE, alongside of average annual operating income growth on equally weighted basis, and in order, to try and transition to a measure that encourages more investment in growth. It goes on to say that this transition to CCE is designed to measure whether returns on new investments exceed an expected rate of return and to encourage investments in growth projects. So this was a company with tremendous cost and capital discipline. They want to maintain that discipline and at the same time increase the focus on investing in growth a bit. And the transition to CCE, again, a customized version of RCE, was an important step in trying to accomplish that. This graph shows a tracking of CCE in dollars on the left-hand axis and the share price in dollars on the right-hand axis. And you can see going back, over 10 years, there's a tremendous relationship between the two. The only year where there's a deviation was in 2017, where the share price jumped in advance of the 2018 performance. And I think when Hunter Harrison joined as CEO, there was an expectation that significant improvements were coming. And so the share price anticipated that. Other than that, it really tracked very well. In the proxy, it goes on to talk about the details a little bit more about the performance measures and how they'll be tracked. They talk about specifically how this use of CSX cash earnings is very consistent with their internal One CSX strategy, which is an attempt to get everyone working and collaborating more together across the organization. Many organizations are going through such strategies right now. And the common pursuit of CSX cash earnings improvement gets people in different departments wanting to work together. Implementation process to embrace a residual cash earnings type of framework is obviously something that has to be done carefully, very quickly. It begins by really understanding the organization and what the gaps are between where the company is now and an ownership culture, to really understand which processes need to change in order to better develop plans and better make decisions. After that, there's some change to those business processes in order to align them with RCE, and by integrating the P&L and capital planning, for example, and building RCE scorecards and that sort of thing. Of course, a heavy emphasis in this presentation has been made on incentive design with the release of a couple of new proxies recently, and designing and really customizing the incentive plan to work in an organization given all of their existing plans and their particular motivations is important. Getting the compensation committee to understand the strong linkage of the measure to share price performance, and introducing the measures for annual and/or LTIP participants. Obviously, lots of training and coaching is required. What is RCE? How can we create a game to get them using it to make decisions so they really learn from it? And how can we teach them how to use it in different types of applications? Obviously, we want to train RCE champions so they're experts around the company and so forth. One of the things we find is very helpful is during this whole process, as real world decisions come up, doing them live, helping people to see how RCE can help drive decisions. We call these acts of ownership, where people do things much more like an owner and less maybe like they did in the past, can really help in the education process and help it to really provide on-the-job training to the people involved in that decision. And then, of course, as with any change management program, there's a constant process of assessing and adapting. If people aren't getting certain aspects of what RCE can do for them, that supplemental training can be provided. And obviously the approach to OCM is customized very much to each company. Every company has a very different culture and approach for such things. And the last thing to talk about is that this is not something that is breaking new ground. Yes, a minority of companies use this kind of approach. Many other approaches are more common. But there are dozens of companies using RCE-like measures in annual and/or long-term incentive plans. And ISS acquired EVA Dimensions in 2018, and so far, both ISS and Glass Lewis, the proxy advisory firms, have supported companies embracing RCE-like incentives. They see it as being good for shareholders. And the last point is that our network of CEOs, CFOs, and CHROs can help throughout implementation for people to be able to turn to those that have been through the process and really understand how they can best work it from inside the company.